All right, all right. Let's get to it. It is FOMC day. We've got Jerome Powell. He's going to come and talk to us in, I guess, about 45 minutes. And in between, in 13 minutes, we're going to get the actual Fed rate decision, which we all pretty much know is going to be a no change. We should see no change in the federal funds rate. Let me go ahead and check in with everybody. So, right now is definitely an important time in the trajectory of what comes next. So, it's not necessarily that um, we're going to expect any change in the rate, but we are going to potentially get some language that'll help us understand a little bit better what's going to be happening with the other tools that the Fed has and what the trajectory of rates could be. Now, the thing that's frustrating is that there's a ton of, how would I say this? There is a ton of political theater around all of this, right? Regarding um, who it is exactly that's going to be the next Fed chair. Is Jerome Powell even going to be able to finish his term as the Fed chair? And then also, will he be able to finish his term as the board governor? Because he is also a governor of the board, regardless of whether or not he's the chair. So he would still be on the board of governors for, I think it is another 2 years, if they don't try to get him out of the Fed in general. So, yeah, that's also something to keep in mind. So, intuition analytics, I see you said the shutdown versus the Clarity Act. Welcome in, everybody. Welcome in. We are just gonna basically go over essentially what's going on um, regarding the follow up to the leading up to what's happening here. So, okay, in October, we had the Fed pretty much announce the end of quantitative tightening. They stopped letting mortgage backed securities roll off of their balance sheet. And in December, this most recent one, we had the announcement of $40 billion in treasury purchases. So that was something that's going on as well now. So, by the way, welcome in everybody. So, another thing that's happening this week is we have um, earnings. Okay, it's kind of earnings season at the moment. So, let me go ahead and pull this up for you guys real quick. We've got some big earnings coming out at the end of the market close today. So there's a lot of stuff that we got to watch out for. So we had Microsoft, Meta, and Tesla all today, as well as IBM. So definitely something to keep our eyes on. Let me go ahead and pull up the charts real quick, looking at the NASDAQ in particular. NASDAQ is pretty much at all-time highs, just short of it. S&P 500 has made a new all-time high today. When it comes to some of these big tech companies, are actually down quite a bit from the highs that we saw. Wow, that was in July of 2025, just for Microsoft. Wow, fantastic. Yo, what's up? So right now, everybody, there's a members only chat. I'm gonna try that out this time just to see if it helps with the discussion. Next time, we'll probably open it up if it's not the right thing. Well, we've got quite a few people in here today. Welcome in, welcome in. So it actually might be pretty useful. What I'm going to do real quick, guys, is I want y'all to do me a huge favor. If you are here and you're watching, then you really ought to subscribe to Memes and Markets, because we go live every Tuesday and Thursday at 12 p.m. Eastern, and we discuss a lot of what's happening in the macro in real time. Every Tuesday and Thursday at 12 p.m. Eastern, we are there and we're chatting. So definitely go and subscribe to us on Memes and Markets. Um, it's so much fun, and we're gonna have some crazy guests on. If you're in the crypto, blockchain space, Web3, we're gonna have some insane guests on in just the coming weeks. And not only that, but we've already got a ton of really cool episodes. I know there's a lot of XRP people in the room, tons of XRP content on here, and we're gonna have some cool people from that community on as well. Back to the topic of discussion. Earnings coming out this week. We've had obviously gold and silver going on a massive generational level run. Okay, they are now the most valuable assets in the world. Okay, you have gold and silver. Okay, what's up to discrete play boss, intuition analytics, Tech Curry XRP in the building. So gold and silver are now the most valuable assets in the world. Okay, so this is a new joke kind of time where we're gonna have to really lock in on what's happening. So silver going crazy. Okay, we hit as high as $117, $118 in the futures market. Gold hitting 5,200 in some numbers. I'm going to actually use the spot market for gold because I know it's probably a little bit higher, 5,300 on gold, and just a parabolic move. Everybody's wondering what comes next for gold and silver. Okay, I think it's definitely something worth keeping up with. So let me go ahead and dive into a couple other things. So one thing about these assets moving like this is that it's not purely just the fact that we have gold and silver is going up in price. A lot of what we're really seeing here is the collapse of the dollar, right? So we've talked a little bit about that on the channel, and I wanted to hear Peter Schiff, the gold bug, the man, the myth, the legend, talking about this himself. So let's hear what he had to say about this. We got the Fed decision in 7
minutes. And the world
is
now pulling the rug out from under the U.S. The dollar is going to collapse. The dollar is going to be replaced by gold. Central banks are buying gold to back up their currencies. True. They're getting rid of dollars. They're getting rid of treasuries. We are headed for an economic crisis, again, that will make the 2008 financial crisis look like a Sunday school picnic. The biggest difference between the crisis that we're about to have and the one we had back then is this one is all in America. It's not going to be exported to the rest of the world. It's not a global financial crisis. It's an American financial crisis. And
so pretty strong words here from Peter Schiff. This is his moment, right? He's definitely been waiting for an opportunity to dunk on everybody. and that is exactly what he's able to do right now. So that is one of the things that's happening right now. Definitely worth paying attention to. We also had Trump make a statement just the other day. I think this was yesterday.
Value of the dollar. Do you think it's declined too much?
No, I think it's great. I mean, the value of the dollar. Look at the business we're doing. No, dollar's doing great. You know, it's very interesting. If you look at China and Japan, I used to fight like hell with them because they always wanted to devalue their yen. You know that? The yen and the yuan. And they'd always want to devalue it. They devalue. And I said, not fair that you devalue because it's hard to compete when they devalue. But they always fought, no, our dollar's very good.
So a big part of what's happening here is also the fact that we have a little bit of a currency war going on. Oops. And so, you've got China and Japan all for the past few years, and really the past couple of decades, have been trying to keep their currencies cheap. Why do they want their currencies to be cheap? They want their currencies to be cheap because that increases the exports that they have, right? If my currency is worth less, then the goods that I'm selling in my country, right, in my currency are now cheaper to the other people who have a currency that is stronger. And so this is a big part of how China has been able to become this massive exporting nation and how they've come to become basically the most dominant player in global trade. When you actually look at the numbers now, China has actually overtaken the United States as far as the actual trade relationships and the amount, I believe, the volume of goods that is flowing through that. So, Trump, and this happened really in the first term as well, he started to say, well, wait a minute, I don't like that. I would like to do something about that. And so what has he done? He has tried to find different ways to devalue the dollar. So let's actually take a look at that on the chart because you can see how he has actually done that effectively even in his first term. So let's look at the dollar index real quick, right? When we look at the dollar index, we look back to, back in 2016. Okay, when he was first elected, you had this massive rundown in the dollar. Okay, a lot of this has to do with tariff policies and a lot of the kind of rhetoric around the U.S. Is this the end of the U.S.? All of this kind of stuff that got the U.S. dollar lower, which for the U.S. right is an amazing thing. I put a clip of this in the video the other day. I don't know if I'll be able to find it again, but he was talking about how this is a good thing. This makes us more money, right? Because he was talking about this a while ago. He was talking about how the U.S. dollar being down is a great way for us to make more money, right? Because if our dollar's down, people can buy more of our goods as well. So the first time around, you saw that huge decline in the dollar. Now you saw things kind of come back up. You saw it try to come back lower in 2021, but then bang, huge rally up for the dollar in 2022. a lot of things were happening there. Obviously, you had some pretty massive changes that were taking place. You had inflation running crazy, running rampant. You had a huge hiking of the interest rate of the U.S. dollar, which can increase the demand for dollars, right? And then let's actually try to look at that real quick. Let's look at the federal funds rate. 3 minutes until we get the decision, which we all know what it is, so I'm probably not going to focus in on it too much. Let me see if I can find the federal funds rate on a chart. Here we go. So, you can basically see how the federal funds rate started to come up, right? In August 2022 is when it started to really pull up. And you can see that that's when the dollar had kind of come up to this level as well. And this was being telegraphed, right? You kind of knew a little bit of the fact that we were going to continue to have higher rates. We had to do something to get inflation in check at that time. So that was kind of what happened there. And then, you kind of mosey around. And then what happens? Trump gets back in office again in January 2025. And at that point, you get this massive decline in the value of the dollar within just a few months, really throughout last year. Let's go ahead and just do the measuring real quick. It went down almost a full 10% from the peak to the lows. 12% we saw. And now we're back at these lows, about a 13% decline in the dollar over that time frame, which is no joke. Let me just say it lightly there. So right now we're looking at even just this past week, the dollar was kind of hanging out for the past 6 months. So since even April 2025, we hadn't made any huge, massive moves lower. Let's say from this bottom in July, we kind of moved sideways. And then all of a sudden, this past few days, January 19th, you see a massive push down lower for the dollar, making new lows that we hadn't seen since even last year, and now potentially going down even lower. Now, what this means is that, usually what this means is pretty much the inverse of that you would expect over here in terms of risk assets or even assets that are hard assets, inflation hedges, such as gold and silver. Now, the thing that's also on the tailwind of this, right, is we know that the United States and Donald Trump wants to lower interest rates. So let's actually pull up a quick couple of things because we have some ideas of who might be the next Fed chair. And his name is Rick Rieder, not sure exactly how we're pronouncing it, but he has a 45% chance out of nowhere of becoming the next Fed chair. Okay, so that's with Kevin Warsh at 27% and Christopher Waller at 8% now. So this is according to Kalshi, right? So let's hear what he has to say about what he thinks about rates.
I think you got room to get that funds rate down 100 basis points.
Why aren't they all talking as if they have room? And not everybody agrees with your assessment. They're worried about sticky inflation. They look at the CPI and they say, well, yeah, it beat expectations, but it still shows that it's still a bit of a problem and it's above our target.
So, Scott, I think there's something that's really important. How the interest rate tool affects inflation. You think about the Fed raised rates 500 basis points. The impact on the economy, inflation, I would argue, not terribly significant. The interest rate tool doesn't do a lot today. You think about how companies finance CapEx, big cap. You're not borrowing. You think about the banks are asset liability. The interest rate tool is not that important, except for a couple of big factors. What it does to housing, and you look at mortgage applications, building permits, housing starts, new home sales.
Frozen.
Stuck. The mortgage rate has to come down. You drop the funds rate, there's some yield curve steepening that probably happens. And then the other side of it is, the low income people who are the borrowers, you're actually, they are getting hurt by this. High savings, older people are actually benefiting from the high rates. And the last thing that I will say, I don't think the funds rate has to be at 4 3/8. The cost to the government, we have too much debt in this country to charge an extra 100 basis points. When I think the transmission of how it impacts inflation that I think is dull to start with, is it worth it? It's a pretty high price to pay.
If the White House is listening to what you're saying right now, they're all standing up yelling, yes, yes.
We are now talking about a Fed that can move 25 basis points, and maybe they do it 3 times till the end of the year. Moving 25 basis points of the overnight funding rate is not that exciting. There are so many innovative things. When we finance resi, commercial real estate, asset backs, you think about cap stack, you think about what a Fed could do. So whoever ends up being the Fed chair, there's so many innovative things. How do you use a balance sheet? How do you use liquidity? Where on the yield curve is it?
So this guy wants to lower rates. So, if he gets in there, in the next little bit of time, if this is the guy that they actually end up wanting to put in the Fed chair, then we can expect an even lower dollar in a very, very short period of time. If you can get a 100 basis point drop in the dollar, right? We're sitting at 350 basis points right now. If you get it down to 250 basis points and as close to zero as Trump would want, then the dollar is going to fall off a cliff. We're going to be seeing levels that we haven't seen since the bottoms here in 2021. And that would send assets like gold and silver probably even higher than they already are. Now, you could say that these assets are already pricing in the probability or the possibility of this being the case. And so that is something else to definitely keep an eye on. Now, it is currently time, so we can check officially exactly what the federal funds rate is going to be. Today, it is sitting at 2.25. 2.25. No, that is Canada. That's Canada. So 3.75, we're still sitting at the same rate, right? So we've seen how we had one cut, two cuts, couple cuts, and here we are now, hanging out, wait and see approach. And there's no telling exactly how that ends up. So listen, I've got 1,520 people in here. This is by far the most I've ever had on the live stream. Guys, I live stream every Tuesday and Thursday with Ben on Memes and Markets. So right now I'm sitting at 9,990 subscribers on Memes and Markets. This number should go up substantially right now. If you guys just go over to Memes and Markets and just hit that little sub button, hit the bell notifications, keep them on, because we are going to be going live every Tuesday and Thursday at 12 p.m. Eastern. In fact, tomorrow, I know you guys love to watch Clive Thompson. And guess who we're having on tomorrow? Clive Thompson. He's going to be on the show with us tomorrow. So go and subscribe and turn on the notifications so that you can join us for that conversation. So I'm seeing we're at 10K now. That number should continue to go up substantially. There's way too many people in here to not be subscribed to that. So go and check me out. We go live every Tuesday and Thursday. Now, with all of that understood, we're also going to look at a couple of other things here. So Rick Reader, however we want to call him, also has said some other things about Bitcoin. So one thing about Trump's administration right now is that for sure, by far, almost every single person in the cabinet is pro-Bitcoin, from Scott Bessent to Howard Lutnick in the Department of Commerce. All of these people are pro-crypto. Now, I'm going to check out the chat in just a second, but I do want to play this clip first.
So maybe I'll start with the equity market. I mean, the first thing I would say, we're going through the most extraordinary technology dynamic I've ever seen before. I would stay long equities. By the way, you can buy vol, you can buy volatility very cheaply to manage your exposure. I'd stay long equities oriented to where growth in technology is. In fixed income, income is amazing. You're still clipping 6%. Would I stay 5 years in on the curve? I'd still clip that coupon. We're extending a little bit out. And then, quite frankly, I mean, there's some interesting things to do in privates, bespoke markets. And I think hard assets have to enter the equation today. Gold, Bitcoin, things that give you a little bit of ballast in the portfolio against potential for currency depreciation.
When you talk about Bitcoin should be part of the portfolio, what kind of percentage are you thinking about? Is it a 5%, which generally seems to be what people are talking about, more or less?
It seems high to me. So I run our global allocation fund. Mm-hmm. You know, we're running long equities. You know, we're heavy income. You know, we're running, you know, in the 3 to 5% region on gold. Gold strikes me today as a better currency hedge. Bitcoin tends to trade with vol, tends to trade with the NASDAQ. So we're running considerably lower than that in crypto. I just think it's going to go up, and I think it's a good expression. But 5 seems high to me, but it depends where you are in your life and how much risk you want to take.
Well, we'll see on the stage, the big stage, I said as the headline speaker.
So we've got a guy who might come into the Federal Reserve now who's pro-Bitcoin. And that right there is not something to scoff at and what that means, because the thing is that the Fed is not just the institution that sets interest rates, guys. Okay, they're not just there to set interest rates. They are also the primary supervisor and watchdog of the entire banking industry. And so one of the things that Jerome Powell actually did come out and say towards the end of last year was that banks are totally fine to go ahead and hold crypto and play around with the crypto thing. And when you can get the Federal Reserve and the United States Treasury both on board with the future of what can happen with Bitcoin and digital assets, and you have a Federal Reserve, excuse me, a strategic reserve coming into place, the entire landscape around crypto will be changing. So that 5% recommendation being high, maybe if you're on the verge of retirement, that could be high. But for anyone who has a little bit of a time horizon and we're looking at what's coming next here for the future of this digital asset, I think 100% it's something to keep. 5% is probably an extremely conservative way of looking at that. None of this is financial advice. Please do not take financial advice from a guy who's stuck inside the house talking to YouTube. But yeah, so I think I've seen a couple of questions. By the way, the chat this time is members only. I'm just trying that out, seeing how that feels, if it makes it a little bit more manageable, easier for me to converse and catch up with everything. So if you're in the chat and you're a member, definitely let me know any questions that you may have. Someone asked about the Japanese carry trade. So let's actually look at the Japanese, US Japanese currency real quick, because we had a crazy move that we talked about on the channel the other day. And we're starting to see that move actually did continue going into this week quite a bit. And let's kind of break down a little bit of what happened there. So what happened was on Friday, we had essentially, well, the Bank of Japan held their interest rates at the current rate. There's this fear that they want to raise rates, right? So this is the thing that could be like the cataclysmic thing that crashes markets. Everyone's worried about, could the Japanese reverse carry trade completely destroy the entire market? And well, I mean, to an extent, there is the potential of that happening. And so the reason being is that there's a lot of leverage that is in the Japanese currency. I've seen some people say, "Oh, stop fear mongering on this," or "Stop acting like this is bigger than it is. It's actually only this amount of money that's in the situation." And there's this like rumors about the leverage. And to be fair, maybe there is some merit to that, but for sure, there is a lot of money that has been borrowed in yen. That if the value of the yen is going up, which by the way, okay, this right here is the US dollar versus the Japanese yen. So this chart going down equals the strengthening of the Japanese currency. Okay. So if we start to see a real rise in the value of the currency of the Japanese yen versus the US dollar, then that could actually have a massive impact, right, on markets, because essentially you've borrowed money in yen, and if the value of that yen starts going up, then it's going to take me a lot more of US dollars to be able to pay my loans back. So I'm getting exponentially crushed as the value of the yen goes higher. Okay, so that's the big issue, is I've borrowed money in yen at 0, 1, 2% interest rates, and I'm taking that and I'm going out and I'm buying US stocks that are going up 10, 15% because I bought Nvidia at the bottom, whatever. And so now it's like, well, but if the yen starts going up in value on me, then my 15% in US dollars is declining. Like, that's not that much money. And then you have the fact that the actual rates on the Japanese yen are also going up. So you're not going to be able to borrow in yen anymore. And in fact, you might have variable rate loans, right, that are just going up in interest rate as that time is happening. So if you're borrowing at 2% and you're investing at 5%, but that 2% goes up to 4%, then you've got a much smaller window that you can use to have profits to play around with. And not only that, but you might have like even more leverage on that trade. So that 1% margin that you now have could actually not really be there because you owe someone else somewhere else. So anyways, just wanted to kind of point out why this is such a big thing. What I would say about that is that I don't think there's a clear answer as to when that becomes an issue, right? At the end of the day, this is going to continue to be something that is a non-black swan that's just sitting there on the surface. We really don't know, right, what's going to happen next with that or when it becomes an issue. But what happened on Friday was that right when the Japanese Bank of Japan held rates where they are, there was this rumor that apparently, potentially, the Bank of Japan and the New York Fed coordinated to create a sort of a rate check where they kind of call around to see what people are willing to buy and sell the currency for, the Japanese yen for. And so once they got an idea of that, what that meant is that the US and Japan, they're telegraphing to the market that they might come in and start to buy the Japanese yen to support the currency, to keep it from falling. And if that's the case, then traders are going to front run and start buying the Japanese currency on their behalf. And that is why you see the strengthening of the Japanese yen versus the USD. So the reason that it's like this, by the way, is because you can look at it this way. You can look at the JPY versus the USD to get a better idea of what's happening. But I do want people to be familiar with the USD JPY because that is how people look at it. Okay, this is the standard way of looking at the strength of the Japanese currency. So let's see what's going on in the chat. We've gotten a lot of new things, I think, happening here. Yeah, XRP Chainlink getting murdered. Yeah, so let's look at some of the crypto stuff real quick. I just was on David Gokhshtein's his show today, and I was kind of telling people, like, look, when you look at these charts, this isn't very pretty. Okay, this is not something that you'd want to see if you wanted to see the prices go higher. Now, things can always change on a dime, but I'm not expecting this to be a super beautiful time for digital assets. Now, always things can change really fast, and we definitely want to be prepared for that. We have the Clarity Act coming down the line, and a lot of people on the Clarity Act. Let's talk about that real quick because a lot of people think that it's just not going to happen. And I personally think it will. I think that when we talk about, well, that's cool. When we talk about the kind of support that's happening for it, I think it could happen. Now, the big thing that's looming over that might make it way less likely for that to happen is going to be this government shutdown, which, by the way, I feel like nobody's talking about that. Am I missing something? Why is no one talking about the fact that the government is about to shut down in a day? Did something get resolved? Am I missing some information there? Somebody please let me know. Because that really doesn't make any sense to me. That's going to put a wrench in everything, not just not just crypto. So let me see if I'm missing something here. So yeah, that's the one thing that could slow down the Clarity Act by a lot, because this time around, right, you've got a lot of political stuff that's happening that's preventing the government from moving forward on this. And when I say political stuff, I mean stuff that has nothing to do with economics and finance, right? You've got the Congress is saying that they want to figure out a situation with some of the violence and stuff that's happening in Minnesota, right? And so with that being the case, there's just a lot of different things that would totally prevent the Congress from moving forward on creating this continuing resolution, which allows them to at least extend the deadline to when they need to actually figure out what they're going to do for the appropriations of the budget for the year. So I'm pretty sure the deadline for that is tomorrow. I don't know. Maybe I'm missing something. Like I haven't heard anyone talking about this, really. I mean, very, very few people have I seen talking about this. I know the House passed their appropriations bill. Oh, okay. It's not a full shutdown. That's why. It's just the Department of Homeland Security. Okay, so I don't know about that. So I'm typing things in. So that's something to keep an eye on. That also just puts a whole wrench in everything. So other than that, we've got about 15 minutes until our guy comes on. Okay, that's not what I thought it would be. Government shutdown barreling towards a partial shutdown. Okay, so it's a partial shutdown. Partial U.S. government shutdown will begin on Saturday if the Senate fails to advance a spending measure by then. Democrats are warning they will not vote for the package unless the funding for the Department of Homeland Security is stripped. Doing that would require reapproval by the House, which is on recess this week. IRS is among agencies that would see funding lapse. Okay, so it's not a full government shutdown. Let's see what that partial shutdown actually means. says most of the government could shut down this weekend. But it's just the Fed. It wouldn't halt what they're doing. As I saw some guy talking about that. He was like, funny enough, it won't change this. Anyways. I hate how divided our country is. For anyone who's an American, I hate to see this stuff. It's really, really lame. Like there's certain things that we have to kind of come together on. And when it comes to, this stuff is complex, and I'm not a politician. I never will be. But we definitely got to start being more empathetic with one another. I think that's something that's really lacking right now. So there's 1,930 people in here. That is crazy. I'm not going to lie. I've been doing some of these live streams. Most we ever had was like a few hundred, like 500, 600. So I got to do it one more time. Y'all, go and subscribe to Memes in Markets. It's in the description of this as well. You can see subscribe to Memes in Markets. Just click on that, hit that. And we're going live every Tuesday and Thursday at the minimum. And we're talking about all of this stuff. Tuesday and Thursday at 12 p.m. Eastern. Tomorrow we have Clive Thompson on. I'm just going to make sure that y'all know, because that's a lot of people in here. And it's all live people, right? So I know you guys would love the show. It's so much fun. We make this stuff so much more entertaining than most out there. So anyways, I'm about to start to try to tune into the actual live stream for this. Let's see. We still got a little bit of time. Anyone in the chat, tell me what you want to talk about, and we can keep chopping it up. Do I think that the happenings with the Zcash project, team will lead to a vacuum for other crypto projects that are building privacy layers to take more of a lead? For example, Midnight, ADA, and Sui. I actually don't know anything about what's happening with the Zcash project team. What's happening with the Zcash project team? I'm also going to look at the chart for Zcash because I haven't looked at that in a while. Zcash was one of the few cryptos that has gone absolutely parabolic over this bull run, or this cycle, if you may. And how quickly did it fade itself back down? But let's see what's happening with the Zcash team. I didn't hear anything about that. Yeah, I mean, privacy technology is something that has there's only so many people that are in the room. It's funny because before crypto, there wasn't a huge incentive to be involved, right? But now that you have cryptocurrency, it's actually cool to be in privacy technology, and you get paid pretty handsomely, right, to be able to make this kind of stuff. Top privacy token Zcash falls 14% after key developer team quits over governance clash. So the CEO claims that the team was forced to leave because of changes that made their work untenable. Yeah, I didn't hear that. So the question was, do I think that this will lead to a vacuum for other crypto projects that are building privacy layers? I feel like what Zcash is doing is pretty unique and hard to compete with, right? So I don't know that that's exactly what would happen from that. I personally don't think that that's exactly how it would work. Plus, those guys are probably just going to start their own thing, right? If we're being real. So, Catherine Austin Fitz is fantastic, and so is Andy Schechtman. For anyone who wants to learn more about the metals markets, Andy Schechtman is awesome. Let's see what Trump had to say about getting $4 trillion to young Americans.
$4 trillion of wealth into the hands of young Americans who otherwise would have really started out with nothing. It's really an amazing thing because it gives young children that start out with really nothing, and it gives them, it's more money than anybody could imagine. From their standpoint, they'll have a real start in life, and that's why decades from now, I believe the Trump accounts will be remembered as one of the most transformative policy innovations of all time. And I've done a lot of them. The tax cuts, we've done a lot of them, more than I think anybody. And I think this is going to be one of the most outstanding.
Okay, so okay, so he's trying to get money to the young people, tax refunds, things like that, I guess is the talk of the town today. Let's see what Ray Dalio had to say about real money.
So, for example, last year, American markets significantly underperform foreign markets. And people don't quite realize that. And the best asset class, in a sense, was gold, but think of that as being the money. So in answer to your question, okay, I've learned, that was a lesson I learned, that if there's a depreciation in the value of money, it makes everything look like it's going up. So for example,
So, Ray Dalio is also an incredible person to listen to when it comes to all of this information, because the thing is he actually broke something down for me really, really well the other day. He's been alive long enough to see a world where money wasn't completely always backed by nothing, pure fiat currency, right? There used to be a time where uh, paper currency was simply a note, right? It was simply a representation of real money that was sitting inside of a bank somewhere, which is gold, right? So anyone, I guess this happened in 71, right? So anyone born after 71 technically only saw a world where money, the paper currency, was the actual money. That was the thing, right? That was used as the reserve. And that's such a fantastic thing to think about, because really to people born before then and people who were, adults before then, they understand that this currency thing, this little paper thing, is no different than a check, right? It's almost the exact same thing. I can write numbers down on a check and then hand that to the bank, but that's not money. It's a piece of paper, right? And so listening to him talk about this is something that's so fascinating, because he's really seen the world change rapidly when you had this detachment from the US dollar from gold. And that's another thing that I'll bring up real quick, because another thing that I think might have flown under the radar is Germany's, there was some economist in Germany. I'm not typing very well today. And tomorrow's video is going to be about this. He's been talking about repatriating the gold that they have in America. Now, this is kind of funny, because this mirrors a lot of what we saw back during the 1970s. What happened was France wanted to get their gold back from the United States. And when that happened, the entire dollar system completely collapsed, because essentially the US kept printing money. They kept printing money, right? And they were essentially devaluing their dollars versus the gold. And so people were like, whoa, we want our gold. Okay, we don't want to play around with your little dollar thing. Like, give us our gold back, and let's play the game fair here. You can't just print a bunch of money and inflate your money away, right? And so that led to the US was basically like, well, no. Richard Nixon said, no, we're not going to do that. We're not going to give you your gold back. That gold is ours. What are you going to do about it? Nothing. Like, what are you going to do, France? That's basically what he said. He was like, what are you going to do? And so that essentially kind of has led to the end of the gold standard. They had to basically come up with a whole new system. That was the end of the Bretton Woods Agreement. And I realized I wasn't sharing my screen at all. So let me do that real quick. And now Germany is not doing this per se, but there are people who are calling for the US to do it. And one of these articles that I read, I don't think it was this one, it made me laugh, because the way the dude wrote it was like, it was pretty funny, man. I think it was from CNBC. I don't know. He was like, it's because of the fact that things are a little bit tense right now. They can't trust the US. We're about to tune into the speech in just a minute, by the way, everybody. He said, given the current geopolitical situation, it seems risky to store so much gold in the United States. In the interest of the greater strategic independence from the US, the Bundesbank would therefore be well advised to consider repatriating its gold. Now, I'm going to bring this up in the video tomorrow, but it's kind of funny because last year we had this whole conversation around all of the gold in Fort Knox. And now that I actually just thought about this today, I thought about it. I was like, maybe this was the joke, was that the gold in Fort Knox is not even anywhere near remotely as important as the gold that's in New York. Okay, because it's around 95% of the gold that's in the New York vault is not the US's gold. It's held there on behalf of other countries. Okay. And no one was talking about that at the time. They were only talking about the gold that's in New York. But the real problem would be is if the gold, excuse me, they were only talking about the gold in Fort Knox. But the real problem would be is if the gold in New York that is not the US's gold is not there. So, anyways, this guy said that Trump is unpredictable and everything he does, and he does everything to generate revenue. That's why our gold is no longer safe in the Fed's vaults. What happens if the Greenland provocation continues? The risk is increasing that the German Bundesbank will no longer be able to access its gold. Therefore, it should repatriate its reserves. Now, the other thing of this is that when we look back to what's been happening with Russia, right? The U.S. made a move where they said, "Look, you cannot go and invade Ukraine. If you do that, we're going to essentially seize your assets." And it's one thing to freeze assets, but the US didn't just freeze their US dollar treasury assets, they actually seized them. They said that we will slowly take these away from you. That right there was really, really fascinating, really wild, because now that sets the precedent for everyone in the world to say, well, my US dollar assets are not my assets, right? Because the US can just take them at any point in time. And so we already had over the past decade, central banks continuing to buy gold ever since 2010. Once again, when the US said, oh, we're just going to print our way out of this problem, people were like, wait a minute. That is destroying the value of my US dollar reserves. If someone takes my money that I'm saving with them and they just inflate it away, they say, I'm going to take that money that you've saved with me and I'm going to cut it in half because that's how I'm feeling today. Well, then in that case, then I need to find another place to save my money. And that other place to save their money is gold. And so that has what's already been happening over the past decade. But then you had that problem with Russia and things just picked up the pace even further. And now we're at the point to where central banks are still buying gold. They're still buying gold at levels that haven't been seen before. And that's at prices that are double the prices of gold that we've seen in the past year. So this is a little bit of a background of what's going on. We're about to go ahead and jump into this conference right here and hear what our guy Jerome Powell has to say. So let me get that set up and we will try to decode what he says. Okay, so he's not live just yet. I know there's another one that typically goes live faster. But hit that like button if you're in here. There's 2,100 people in here. For me, that's a brand new record for sure by far. Hit that like button. And if you're new here and you're not a subscriber, subscribe. And if you want to join in on the chats, you can also join as a member. Every Sunday, I'm going to start doing a weekly outlook of what I'm looking at in the markets, just 30 minutes. You can pop in. And then I'm also releasing custom content for people who have questions and just answering and talking about the things behind the scenes on my channel membership. So if you want to be a channel member, that goes for the macro analyst tier. You get access to my weekly outlooks and then also any other extra videos I release for those channel members. And yeah, and like my man said in the chat, go and subscribe to Memes and Markets. We're having Clive Thompson on with us live tomorrow. Okay, Memes and Markets, turn on the notifications bell, because the only thing you're going to get is our live streams. And we go live every Tuesday and Thursday at 12 p.m. Eastern. So tap in. It's so much fun. And if there's 2,300 people there, here, y'all need to go over there. It's so much more fun than this. I promise you. All right, so let's see. Here we go. Oh, snap. My goodness.
See, after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. The temporary shutdown of the federal government likely weighed on economic activity last quarter, but these effects should be reversed as the reopening boosts growth this quarter. In the labor market, indicators suggest that conditions may be stabilizing after a period of gradual softening. The unemployment rate was 4.4% in December and has changed little in recent months. Job gains have remained low. Total non-farm payrolls declined at an average pace of 22,000 per month over the last 3 months. Excluding government employment, private payrolls rose at an average pace of 29,000 per month. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including openings, layoffs, hiring, and nominal wage growth, show little change in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index indicate that total PCE prices rose 2.9% over the 12 months ending in December, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. In contrast, disinflation appears to be continuing in the services sector. Near-term measures of inflation expectations have declined from last year's peaks, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5 to 3.75%. Since last September, we have lowered our policy rate 75 basis points, or 0.75 of a percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2%, once the effects of tariff increases have passed through. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you. I look forward to your questions.
Hi, Chris Rugaber at Associated Press. Thank you. I wanted to ask that, you attended the Supreme Court hearing last week on the Lisa Cook case, and Treasury Secretary Scott Bessent criticized that as political. Can you say why you attended and what you would say in response to the Secretary's criticism?
So let me start with, I don't respond to comments by other officials, whoever they may be. It's just not appropriate to do that. I will tell you why I attended. I would say that that case is perhaps the most important legal case in the Fed's 113-year history. And as I thought about it, I thought it might be hard to explain why I didn't attend. In addition, Paul Volcker went to a Supreme Court case famously in, I guess, 1985 or so. So it's precedented, and I thought it was an appropriate thing, and I did it.
Great. And then just quickly follow on the job market. You mentioned last month that the household survey might be distorted, and you also mentioned the potential for overcounting jobs, which would suggest that we're still in a negative hiring pace. So do you see the drop in the unemployment rate as solid? And what's the basis for saying that things have stabilized? Thank you.
So, yeah, really two questions. One is, so we're getting through the distortions in the data from the shutdown. However big they were in November, they're smaller in December. So we're getting to a place where they're no longer material. They're still there, but it's a tweak here and there. The reason why we changed the statement, let me pull it out, was simply, it used to say that judges that downside risks to employment rose in recent months. So we saw, data coming in which suggests some signs of stabilization. I wouldn't go too far with that, but some signs of stabilization. There are also some signs of continued cooling. And so we thought that was no longer an accurate description of the data. In addition, the outlook for economic activity has clearly improved since the last meeting, and that should matter for labor demand and for employment over time. So for those two reasons, we thought we would take that language out of the statement.
Nick Timrose, The Wall Street Journal. Chair Powell, you've generally avoided engaging with political controversies directly, and the video statement on January 11th was a departure. What made this different, and are you concerned it could draw the institution further into political debates?
So today I'm simply going to refer you to the statement that I made on January 11. I'm not going to expand on it or repeat it. So I'm just not going to. This is really about the press conference and the economy and what we did today, and some ancillary areas, but I'm not going to be getting into that.
Can you say whether the Fed has responded to the subpoenas?
I have nothing for you on that today.
Mike.
Michael McKee from Bloomberg Radio TV. Have you made a decision on whether you would remain as a governor of the Federal Reserve? And if so, would you tell us what it is? And if not, when might we anticipate a decision?
No, and I really, once again, have nothing for you on that today. That either.
Why would you want to leave it all under the circumstances?
Again, I don't want to get into this. It's not something I'm. There's a time and place for these questions, but not something I'm going to be getting into today. Thank you.
Thank you. Claire Jones, Financial Times. Thanks a lot for taking my questions. In another one that might, lead to a similar answer. We've seen quite big movements in the dollar over recent days. What do you think is driving the U.S. currency lower? And have you been at all concerned just by the extent of the volatility we've seen this week? Thank you.
So, Claire, as you probably know, we don't comment on the dollar. Really, the administration, especially the Treasury Department, has the job of oversight over the currency and exchange rates and all that. We don't comment on that. It's not our role. So I have nothing for you.
What's your view on the market movements? What do you think behind them? Is it asset managers diversifying? Is it?
Yeah, I just don't. We don't talk about the dollar. We don't talk about what moves it around. It's just not appropriate for us to do so. Really, the Treasury Department has that. It's their role, their bailiwick, and we stay off it. We do monetary policy and some other things, but we don't comment on the dollar. Sorry.
Neil.
Hi, Chair Powell. Neil Irwin with Axios. Obviously, no SEP in this meeting, but in light of the slight firming up of the language around growth in the labor market in the statement, should we assume that the timeline for any further rate cuts is pushed back compared to what people might have thought in December?
Well, first of all, if you look at the incoming data since the last meeting, clear improvement in the outlook for growth. The data have come in, and sentiment, the Beige Book, everything comes in suggesting that this year starts off on a solid footing for growth. Inflation performed about as expected, and as I mentioned, some of the labor market data came in suggesting we're evidence of stabilization. So it's overall a stronger forecast, really, if that's your question. I'm not sure I answered your question.
But in terms of timing or pacing of any additional easing?
So we haven't made what we'd say about this was that after this meeting, after the 3 recent rate cuts, we're well positioned to address the risks that we face on both sides of our dual mandate, and we'll continue to make our decisions meeting by meeting based on the incoming data, the implications for and the outlook and the balance of risks. Haven't made any decisions about future meetings, but the economy is growing at a solid pace. The unemployment rate has been broadly stable, and inflation remains somewhat elevated. So we'll be looking to our goal variables and letting the data light the way for us.
Steve.
Steve Leisman, CNBC, and sticking with questions you might answer, thank you. You had previously, I believe, described the current policy rate being at the higher end of neutral. And if you look at the longer run, the S&P and the longer run rate, 16 of 19 officials are actually below there on their long run. Is the Fed still in a process of bringing it down towards a middle range of neutral? And what would it take to get there?
So the count I did was that 4 of the 19 were at or above that. Maybe I missed by 1, but I thought it was 4. And if you look at the dealer survey, it was 10 out of 58 where we're at or above. So you're right. It's the higher end of the range. What we say is it's within the range of plausible estimates. This is the higher end of that range, but so for some people they think it's neutral. I think, and many of my colleagues think, it's hard to look at the incoming data and say that policy's significantly restrictive at this time. It may be sort of loosely neutral, or it may be somewhat restrictive. It's in the eye of the beholder, and of course no one knows with any precision. Is that, you had a follow-up?
I get what you're saying, but some officials have described the Fed being in a mode of bringing it down eventually over time. Are you still in that mode, or is this a place to hang out?
Yeah, no, I would say if you look at the S&P from December, most people had additional normalization. But at the same time, we've done a lot of the process of normalizing. A good piece of it is done with 75 basis points, and before that, 100. It's 175 basis points we've cut since we began cutting in September of 2024. So you've moved now to, Fed funds is running just a little below 3.65%. So you've moved a good way, and we think we're well positioned here to watch how the economy performs, look at the data. We're not making decisions about future meetings, but we do think we're well positioned after those 3 cuts to let the data speak to us.
Amira.
Thank you, Chair Powell. Mara Mokway from Bloomberg News. To what extent?
I had a crazy idea. We were surprised that no one had done it before.
So are you all thinking about the conditions that would merit another rate cut? Is there broad agreement on the committee about what it would take?
So there was broad support on the committee for holding today. Broad, I would say, including among non-voters. So that's where that was. Of course, some people did want to cut and dissented, but committee pretty broadly for holding today. We're not trying to articulate a test for when to next cut or whether to cut at the next meeting. What we're saying is we're well positioned as we make decisions meeting by meeting, looking at the incoming data, evolving outlook, and all that. And we're in a position where we still have some tension between employment and inflation, but it's less than it was. I think that the upside risks to inflation and the downside risks to inflation have probably both diminished a bit. So, we'll be looking at that. It's about how you weigh the risks to the 2 goals and how big those, and quantify them. And so there are different views on the committee, and, we'll find our way forward as the data evolve.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. Has the effects of tariffs already moved through the economy on prices?
A lot of it has. So basically, there are many different estimates, and they're all highly uncertain. But most of the overrun in goods prices is from tariffs. And that's actually good news, because if it weren't from tariffs, it might mean it's from demand, and that's a harder problem to solve. We do think tariffs are likely to move through and be a one-time price increase. So most of the overshoot, if you were to take that out, you'd get, and you would, I mean, inflation, core PCE inflation is running just a bit above 2%, x the effects of tariffs on goods. And the other good news is, if you look away from goods and look at services, you do see ongoing disinflation in all the categories of services. So that's a healthy development. So that's what's going on. The expectation is that we will see the effects of tariffs flowing through goods prices, peaking, and then starting to come down, assuming there are no new major tariff increases that are begun. And that's what we expect to see over the course of this year. If we see that, if we see that, that would be something that tells us that we can loosen policy. Also, if we see something that suggests that the labor market is not stabilizing, that in fact the downside risks reemerge or the data just get worse, we'd have to look at both of those. We have a two-sided mandate.
If I could, if President Trump does pick a new Fed chairman before May, what does that look like? How would you work with that person, and what does that transition period look like?
I don't have anything for you on that. That will depend on Congress's actions and things I can't speculate on.
Howard Schneider with Reuters. Thank you for taking our questions. Given the changes in the statement and all you've said so far, is it fair to describe risks to both sides of the mandate as roughly balanced right now? And is the next move necessarily down?
I'd say that the upside risks to inflation and the downside risks to employment have diminished, but they still exist. So there's still some tension between the mandates. Are they fully in balance? Hard to say. And we think our policy's in a good place. I've just discussed reasons why we might change our policy, and we'll just have to see how the data lead us.
I'm wondering, you a minute ago you said you felt expectations were consistent with your mandate, that the 2 and the 10-year break-evens have moved quite notably in the last couple of weeks, I believe. Is there any concern on that front?
I mean, I recently looked at all of the both survey and market-based short-term inflation expectations have come way down. They were in a good place at the beginning of last year. They spiked around Liberation Day, and now they've fully retraced in the last few months. So that's very comforting. And the longer-term inflation expectations have remained in places that are very consistent with 2% inflation over time. So expectations have been solid, and they reflect confidence in the return to 2% inflation.
Andrew.
Apologies if this is a little bit repetitive, but in the past you've said that the reason you cut rates was that the risk to the labor market was greater than the risk to the inflation side. Is that still true?
We haven't made. You're right. We saw the labor market weakening, and we acted, and I think that was the appropriate thing to do. We will always act to address what we see as the economy moving away from our goals. Risks to both of the variables are a little less. I think the upside risk to inflation, again, a little bit less, and the downside risk to employment, a little less. I just would say that I'm not making a judgment about how, one of them is more at risk than the other, just that the risks to both of them have diminished.
Okay, thanks. BIS wrote a paper last summer which concluded that global investors were hedging their dollar exposures in ways that previously they hadn't because of policy uncertainty. Do you agree with BIS?
We really don't see much at all about that whole story. There's just not a lot of data that suggests that there's much to that.
Thanks.
Anna Swanson with the New York Times. Can you talk more about what you would need to see in the labor market to conclude it's time to resume easing? Do you need to see further deterioration in the labor market, or would it be enough for inflation to soften?
So we'll always be looking at both things. And so there could be combinations, infinite numbers of combinations that would cause us to want to move. Certainly, a weakening labor market would be an argument for loosening. But what's happening with inflation? If inflation were at the same time getting worse, you just just have a very difficult situation there. So we'll be looking at both. Clearly, a weakening labor market calls for cutting. A stronger labor market says that the rates are in a good place. We'll have to be making similar judgments, too, on inflation, though.
And if inflation does pick back up and the labor market doesn't show further signs of deterioration, is there a chance that you could raise rates rather than simply remaining on hold? What would you need to see to consider hiking?
We don't take things off the table, but it isn't anybody's base case right now, anybody's base case, that the next move will be a rate hike. But, ultimately we'll do what we think is the right thing. But that's not where people's expectations are right now.
Victoria.
Hi, Victoria Guida with Politico. I wanted to ask, you've talked in the past about concerns about the U.S. fiscal trajectory, and we've seen in the Japanese bond market a lot of turmoil recently, in part due to concerns over their fiscal and long-term economic outlook. So do you worry that the U.S. could at some point find itself in a similar situation to Japan, whether for fiscal or demographic reasons?
Over time, you've seen that U.S. rates have remained they haven't moved a lot really for a while, but they haven't moved a lot because of what's been happening in Japan. So it's more of an over time thing. The U.S. federal budget deficit is, uncontroversially on an unsustainable path. The level of debt is not unsustainable. It's very much sustainable, but the path is unsustainable. And the sooner we work on it, the better. But right now we're running a very large deficit at essentially full employment, and so the fiscal picture needs to be addressed, and it's not really being addressed. So that's important. I'm not in any way connecting it to some sort of near-term market event, but ultimately it's something we'll have to deal with, and that in the end game, that's where you wind up, is in some kind of a difficult thing. But that's not where we are. It's not where Japan is either. But it's certainly not where we are right now.
Does it reduce the effect of your rate cuts that longer-term rates have overall not really budged that much?
I wouldn't say that. The thing is, technically, higher longer-term rates means less accommodative financial conditions. But remember, many things move longer-term rates. It's not mostly what happens on the short end. There can be effects of longer-term rates from our moving our policy around, but it's much more assessments of the fiscal path and fiscal policies and risks and things like that move the 10-year around. You can look back at and find periods where we've been very actively moving the policy rate over the course of a year, and over the course of that year, the 10-year is exactly where it started. So there's not a tight link between 10-year rates and the overnight rate.
Elizabeth. Thanks so much, Elizabeth Schulze with ABC News. Republican Senator Tom Tillis, who sits on the Senate Banking Committee, said he will block any Fed nominee, including the chair, until this investigation into you is resolved. Do you support this move by the senator, and what conversations have you had with the senator?
I've got nothing for you on that.
More broadly, what would happen to American households if the Federal Reserve loses its ability to operate independent from politics?
So really, the point of independence is not to protect policymakers or anything like that. It just is that every advanced economy democracy in the world has come around to this common practice. It's just an institutional arrangement that has served the people well, and that is to have a separation between to not have direct elected official control over the setting of monetary policy. And the reason is that monetary policy can be used, through an election cycle to affect the economy in a way that will be politically worthwhile. So I'm not talking about the U.S. context. This is every advanced economy democracy of any size. So it's a good practice. It's pretty much everywhere among countries that look at all like the United States. And I think if you lose that, first of all, it would be hard to restore the credibility of the institution if people lose their faith that we're making decisions only on the basis of our assessment of what's best for everyone, for the wide public, rather than trying to benefit one group or another. If you lose that, it's going to be hard to retain it. And we haven't lost it. I don't believe we will. I certainly hope we won't. But it's very important, and the reason it's important is that it's enabled central banks generally not to be perfect, but to serve the public well.
You're confident it can maintain that independence at this point?
Yes. I mean, I'm strongly committed to that, and so are my colleagues.
Archie.
Thanks. Archie Hall from The Economist. On that sort of stabilization of the labor market question, how much do you see the weakening we saw over the past 6 months, year, as a kind of data mirage around immigration and the government shutdown and so on that's now resolved? Or how much have we seen a kind of real underlying firming up in the state of the labor market, do you think?
Well, part of it is, to your point, part of it just is that labor supply, growth in labor supply has come to essentially a halt from a fairly fast clip of growth over the last couple of years, driven by immigration, and then the halt being driven by a very sudden stop in immigration. So many outcomes were possible with that. Supply came way down. It turns out that demand for labor also came down a very similar amount, maybe just a little bit more, which is why the unemployment rate has gone up. So I don't know whether that's a coincidence or not, but that's what's happened with that part. But if you look at other things, like, for example, just to pick a couple, the Conference Board's measure of job availability that came out, I don't know, was it yesterday or today? But, it shows, it's a survey showing that workers feel like job availability it's a very low reading. It's just one reading, but it's an indication of softening.
Welcome, Eric.
People, part-time for economic reasons, which is a category within the broader U6 category measure, has moved up significantly. So there are lots of, and I could go on and on, there are lots of little places that suggest that the labor market has softened. But you're right, part of payroll job softening is that both the supply and demand for labor has come down. Growth in those two have come down. So that makes it a difficult time to read the labor market. So imagine they both came down a lot to the point where there is no job growth. Is that full employment? In a sense, it is. If demand and supply are in balance, that you could say that's full employment. At the same time, do we really feel like that's a maximum employment economy? It's very challenging and quite unusual situation.
Thanks. And one more on growth and the kind of strong growth outlook, or strengthening growth outlook you're now seeing. How much of that is the fiscal stimulus we're seeing from the beautiful bill, the tax cuts, and all of that?
So you're seeing it already. You don't have much of the fiscal. I think the outlook, you're right. It's financial conditions, and it's fiscal policy for 26. But you've got strong consumption that's been happening before financial conditions have been supportive, but before the fiscal effects really are shown. So essentially, the economy has once again surprised us with its strength, not for the first time. Consumer spending, although it's uneven across income categories, but consumer spending overall numbers are good, and we're benefiting from the AI build out of data centers. That's another thing we're benefiting from, but. The economy overall, the growth is on a solid footing. It looks like, and it's not just those things. It's just the consumer is filling out surveys that sound really negative and then spending. So there's been a disconnect for some time between downbeat surveys and reasonably good spending data.
Thanks, Chair Powell. Christine Romans from NBC News. You talked about how consumer spending is uneven. The president calls inflation defeated and solved. The FOMC says it's a somewhat elevated inflation. But you talked about those customer survey or those consumer sentiment surveys and public opinion polls that show that most families say the cost of living is still issue number one. What is the conversation around the table with your colleagues about how wealthier consumers seem to be driving so much of the economy, and why so many families still feel like they just can't make ends meet after 5 years of rising prices? What is that discussion like?
So a couple things. One, there's something to it in that we know that higher income households that tend to own real estate and tend to own stocks, securities, and those assets have been going up in value, and increases in wealth do support spending over time. So, and that's clearly a part of the story. We also know that for some time now, for a year or more, we've been hearing from retailers, for example, that serve lower income customers, whether it be food or the big box stores or anything. They're saying the same thing, which is our consumers are looking to economize. They're trading down from brands, and they're buying less, and it's changing their buying habits and that kind of thing. So we're seeing that, and that is a reality of what we're seeing. They're still consuming, but they're feeling it in a different way. I would say more broadly on affordability, we have a vast network through the reserve banks and also through the Board of Governors, where we talk to small and large businesses and households, and so we do hear a lot about affordability, and we take that very seriously, and we take it to heart, because one of our jobs is price stability, and so the best thing we can do for people who are feeling that squeeze is to keep inflation under control, and frankly, to finish the job of getting inflation back down to 2%.
You mentioned the AI build-out as being a positive for economic growth this year. I wonder, as you look at the weakest year last year for job creation of a non-recession year since like 2003, are you concerned about AI maybe supplanting more entry-level work and entry-level jobs, and how does that play into what you're watching about the labor market?
So everyone, of course, is watching AI and the deployment and, trying to understand exactly what's happening. And there's a wide range of possibilities. It's hard to say. And of course, anyone who uses it is amazed at what it can accomplish, right? So every technological wave will eliminate some jobs and create other jobs. And it's always been the case. If you look back, wave after wave after wave, there will be some disruption, but ultimately technology increases productivity, which is the basis for rising wages. And it may not all happen immediately, but over time, it's what enables incomes to rise over time, is rising productivity. So and we always ask, well, this is going to be different, is it going to be different? And we don't know. And we may, in any case, see in the short term jobs that are being eliminated by the capabilities of AI. We may see that. We just don't know what the overall effect is going to be. So how to think about it in macroeconomic terms, it's very hard. We can look at the aggregate data. We can analyze, for example, there is some connection, it appears, between the low hiring rate for recent college grads and AI, but it's not the main or only driver. You hear large companies, though, many of them saying that they either won't be hiring for some time, or that they're hiring less, or that they're laying people off, and they tend to refer to AI.
Huge Amazon layoffs
when they
today.
do that. So we're all watching and learning, and it could certainly have pretty significant effects on the economy, the workforce, and our society. We don't really have the tools to address the concerns that may arise, but we have a lot of people who focus on analyzing it and try to understand what the macroeconomic implications are, which is our job.
Becky.
Thank you, Chair Powell. Bei from AFP News Agency. You mentioned earlier that on inflation, the broad expectation was for a one-time price increase and then for inflation to come down. And I was wondering, is your expectation still for inflation to start cooling in the second half of 2026? And if you could elaborate how far we are from target currently. Thank you.
So how far we are from target is, as I mentioned in my opening remarks, we had 3.0% core PCE inflation over the 12 months ending in December, and that's pretty much what we had the year before. So on net, no progress, but the story behind that is modestly positive in that most of the overshoot was in goods prices, which we think is related to tariffs, and ultimately we think those will not result in inflation as opposed to a one-time price increase. Okay, so
I always say you can't manage what you can't see. Monday.com shows you the full picture like that.
understand really clearly, precisely when this will happen. But there's an expectation that sometime in the middle quarters of the year, we'll see tariff inflation topping out. So what we do is when a tariff is put in place, we track the effect of those tariffs over a 6, 7, 8, 9 month period, and you can see, for that tariff how long it takes to reach a place where it's affected the price level, and that's it. So we're getting better at that, and our estimate is that it'll be sometime in the middle of the year, but I wouldn't look for great precision in that. But we'll be able to see whether things are moving in that direction. I think we'll be able to see.
Richard Escobedo.
Thanks, Chair Powell. I'm Richard Escobedo with CBS News. I want to look outside the U.S. about what's happening outside our shores and how it impacts the U.S. Canada's Prime Minister said last week that there's been a rupture in the global order, and I wonder how you're thinking about geopolitical risk as it relates to the U.S. economy.
So I can't comment on that speech or statement or anything like that. Geopolitical risk for us is, a lot of it is around energy, oil. And so far we haven't, for all the turmoil, oil prices have come down, as you know, and so we don't really see much. Longer than that, it's trade, and the trade, the economy, our economy has pulled through pretty well, you'd have to say, given the very significant changes in trade policy. The U.S. economy has pushed right through. Partly that is that the way that what was implemented was significantly less than what was announced at the beginning. In addition, other countries didn't retaliate, and in addition, a good part of it hasn't been passed through to consumers yet. It's being taken by companies that stand between the consumer and the exporter. So that's where that is.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. With third quarter GDP growing at 4.4% and the fourth quarter expected to have a 5 handle on it as to what the Atlanta Fed is predicting, at a time when you had a government shutdown and we thought that was going to shave off some growth, you've also got the fiscal tailwinds you've talked about, big tax refunds coming, potential tariff dividend. How could you cut rates and not spur inflation in that environment?
Well, we didn't cut rates today, but it depends on how fast potential output is growing, right? I'm just asking in principle. I'm not saying this is what's happening, but there's growth and there's how fast the potential is growing, and at a time of high productivity growth, potential output is rising. So it really matters whether potential output is growing as fast as actual output, and it would matter over time. The numbers you cite were for quarters, and quarterly GDP is, you need to look at 12 months because quarterly GDP can be very lumpy. GDP was negative in the first quarter last year. So the overall, over the year, the numbers were nothing like that. It was more in the mid-2s for the year.
And how do you explain the divide right now between strong economic growth and the job market? Is it productivity that's filling the gap? And is productivity being driven by AI at this point?
So there has been, you're right, there has been a divide of solid growth, but what looked like a weakening labor market. And that can be explained by rising productivity. But I would say we do see signs of certainly of the unemployment rate stabilizing. So it may be we're seeing the beginning of the resolution of those two things. Also, as you probably know, the lore is that when GDP and the labor market get into an argument, in the end, the labor market data is more reliable. GDP data is just very hard to collect and understand, but nonetheless, I think we may be seeing that tension resolving a little bit. Too soon to say with any confidence, though.
Matt Egan.
Matt Egan with CNN. Chair Powell, after today, you have 2 meetings left as Fed chair. You've obviously experienced a lot during your time as Fed chair, served under multiple presidents. I'm wondering what advice you have for whoever your successor might be.
lastly, I'd say a couple of things. One is stay out of elected politics. Don't get pulled into elected politics. Don't do it. And that's another thing. Another is that, our window into democratic accountability is Congress. And it's not a passive burden for us to go to Congress and talk to people. It's an affirmative, regular obligation. If you want democratic legitimacy, you earn it by your interactions with our elected overseers. And so it's something you need to work hard at, and I have worked hard at it. So, and the last thing is, it's easy to criticize government institutions so many ways. I will tell whoever it is, you're about to meet the most qualified group of people you not only have ever worked with, you will ever work with. And when you meet Fed staff, and not everybody's perfect, but there isn't a better cadre of professionals more dedicated to the public well-being than work at the Fed.
Thanks for that answer. If I may follow up, as I'm sure you've noticed, gold and silver prices have experienced historic gains of late. And I'm wondering how much attention, if any, you pay to those moves and what message you may take from these significant price increases we've seen for precious metals.
Don't take much message macroeconomically. The argument can be made that we're losing credibility or something. It's simply not the case. If you look at where inflation expectations are, our credibility is right where it needs to be. So we look at those things. We don't get spun up over particular asset price changes, although we do monitor them, of course.
Nicole, for the last question.
Hi, Nicole Goodkind-Barron's. Some prominent critics have charged that the Fed's economic models are somewhat backward-looking, but should be more forward-looking, incorporating things like productivity increases from AI. How do you incorporate current and future developments into your analysis and decision-making, and do you have an answer to those critics?
Yeah, so by and large, those criticisms, as somebody on the inside, they just don't make sense, and I'll tell you why. Every FOMC participant writes down a forecast every quarter, right? The summary of economic projections, and that's the basis for how we think about the economy. So, and the other thing is, what an economic model can do is it can grind up all the data for the last number of years, 50 years, let's say, and it can identify what are the relationships between variables A, B, C, D, and all that kind of thing. And it can tell you if you change one of those variables, this is what should happen in the macroeconomy. That's just the way it works. However, the structure of the macroeconomy is constantly changing. For example, we hadn't had a pandemic in 100 years. It wasn't in the model. And we knew it from the very beginning. It was not in the model. A trade war of this scope, we'd never had that in 100 years. And so there's great uncertainty at different points. Another thing I'll say is, when it comes to, technological developments that raise potential output, some kind of technological revolution like happened in the 90s here and like maybe happening now with AI. We're all over that. And, everyone studies those periods and, we're very clear-eyed about the possibility that this higher productivity may persist and also that it may not. We're not, no one's sitting here unaware of the possibility of higher productivity. We've been talking about it for 3 years. It long predates the current situation. It's been going on for 5 or 6 years. We've had productivity higher. We've been talking about it that whole time. So it's very much on our minds, and we are well aware that higher productivity means higher potential output, and it changes the way you think about potentially inflation, growth, labor market, and all those things. That's all in our models. I mean, if it's just a question of using better models, bring them on. Where are they? We'll take them. But I think, we certainly are in contact with anybody who does economic modeling, and we're always looking to do better at that. But that's how I think about that.
And just a quick follow-up. We've been talking a lot about tariffs and passing through, and we've been talking a lot about them for the past few months. The trade landscape is still in a constant state of flux. Announcements, threats, negotiations, they're all frequently changing. So I'm wondering how you actually track these? What data or channels are most critical to follow this in real time?
Trade?
Yeah, the impact of tariffs and how they're changing.
Yeah, I think our staff has done a really nice job on that, and they've kind of put it together in real time. So as I mentioned, a tariff gets put in place, you can pretty much track its effects on pricing and on everything, and so you build a model up from all of the tariffs. At the beginning, it was very much of a forecast. Now it's every cycle that goes by, it becomes more informed by actual data, and our forecasts were not far off. What changed was, as I think I said earlier, what was implemented was smaller than what was announced. In addition, we didn't see retaliation internationally, and I think people did generally expect that because we saw that in the past, and that really mattered too. And then the other thing is that pass-through didn't know how fast that was going to be to consumers, didn't know how much exporters would take, how much companies in the middle would take, and how much the consumer would take. And it turns out it's a lot of companies in the middle who, by the way, are pretty strongly committed to passing the rest of it through, which is one of the reasons why we need to keep our eye on inflation and not declare victory prematurely.
Thank you.
We're done?
We're done.
Okay. Thank you very much.
And we're done. All right, folks. So there's quite a bit to talk about there. Let me get my screen up and turn them off. So, well, congratulations for making it through another FOMC meeting. And welcome to all of the new members of the channel. So let's take it from the top. I've got quite a few notes that I've been taking here. One of the big things that I think, obviously the Fed has two major mandates. It's maximum employment and steady prices, stable prices. They're looking for a 2% PCE inflation number and maximum employment. And one of the things that was made clear about this meeting today is that there's really not a very clear definition of what maximum employment actually means, right? So that's something that can be a little bit problematic when trying to make decisions as a Federal Reserve chairman. So one of the things that he's said is that inflation expectations in the short run, right, have come back down, whereas the long run inflation expectations still remain sticky at around that 2% level. And so what that really means is that they're essentially not necessarily looking, they're not looking to cut rates just like willy-nilly. There's still a chance that the long-term inflation expectations could tick up if they try to reduce that short-term interest rate. Now, he also talked about the 10-year. He talked about the link between the 10-year interest rate versus the short-term federal funds rate. And what he basically said is that he doesn't feel like that's necessarily super well linked together. Now, that's something that's pretty interesting to say when you really think about it. If you lower short-term interest rates, the inflation expectations can then show up, and the inflation expectations are what the bond markets will eventually reflect, right? When they determine that they think that there's long-term inflation, then they will actually go ahead and essentially sell off bonds, which will raise the overall yield of these longer-term yields. But what he's saying is that it's not necessarily that directly correlated or linked what is happening in the short-term markets. So that was a couple of things that I thought were really important about what was said. And then let's see. Okay, so there's some language in there that he talked about that I want to bring back up. He said that the normalization, he's looking for normalization. And I believe what he's talking about here is a normalization of the actual, the rate, right? So there's a couple of terms here. The neutral rate in the market. So the neutral rate is what they're trying to achieve at all times, essentially, right? Unless they need to have an easing of conditions or a tightening of conditions, meaning either encouraging or discouraging borrowing. So this term of normalization is trying to get to where you can get a neutral rate for the federal funds rate. And that neutral rate, right, allows for there to be that maximum employment and for them to hit that 2% inflation target without having to do anything else. And what someone asked was that they felt like they saw a survey or somewhere there that 16 out of 19 of the dealers in that survey, dealers are essentially banks, okay, that are buying and selling bonds and stuff. They said that they felt that the actual target rate might be lower than what the current rate is what I was interpreting from the question that was being asked. And so essentially, basically he was saying, why won't you lower rates? And so I want to come back to some of this too, because Jerome Powell keeps on saying one of the things that we kind of all know outside of the Fed is that the inflation metrics that they're looking at, the CPI and the PCE, might not fully be representative of what's actually going on in the economy right now. Another thing that he did say about the tariffs that I think is worth mentioning is that he said the tariffs are a one-time shock to prices, is what they've been able to actually fully see now that the data has continued to roll in. And because of that, it's not as big of a concern anymore. They said that they saw around a 2% impact on inflation from these tariffs. Now, let me keep looking at my notes here. So he stayed away from commenting on the dollar, which I thought was really interesting. It's not their job. That's the Treasury's job to pay attention to what's happening with the dollar. He obviously also stayed out of the political things, which was really funny. They kept on asking him about the video that he put out. It's wild that they even put that video out, to be fair, regarding the lawsuit that was potentially opened up against the Federal Reserve. So let's see. Another term that was thrown out that I thought was worth talking about is so the GDP equation that's happening, right? So the GDP is consumption, right? So rather spending, investment, you have government spending, and then you have net exports. And so he was talking about how, what was he saying? So the government spending, they were asking whether or not government spending was the real reason that you had a higher GDP. And basically what he said was that it played some of a role, but it wasn't the whole thing. Consumers are still spending. Okay, now the high-end consumer, right, is the one that's really spending the money, and the low-end consumer is not spending as much. And so this term that he used was economizing. He said that the lower end consumer is economizing, which means that they are reducing the amount of money that they're just spending, right? They're being more conscious about the decisions that they're making in the supermarket, right? Not anything that you couldn't pick up without a little bit of context there. But I thought that was an important word to go ahead and highlight as well. Welcome to everyone who is joining the memberships. I see Elim coming through, Ermias earlier. And then thank you guys for the super chats. I really appreciate you guys for everything that you do. Eric came in earlier, and then we had Brian Richards. I saw you come in earlier as well. So welcome. Thank you for being a member to the channel. We've got a lot of cool stuff coming with that. So, but lower USD equals lower inflation. Lower USD equals lower inflation. Wait, oh no, it equals inflation. Sorry, I see what you're saying. So, it's not necessarily that direct, right? The real thing, and let me pull this up so that we can talk about this. The real thing, no, this one. The real thing to look at when it comes to inflation is really the money supply, okay? So it's not just having a lower dollar value on the global stage that leads to inflation, because that's kind of a separate concept. It's also how much money is actually in the economy. And now, this is a crazy chart to look at. This is the US M2. As you can see here, in recent times, we've actually gone out and made new highs in the total money supply that hadn't been seen since 2022. So in March, April last year, we finally got back to those all-time high levels, and we're continuing to surge from there. Now, the reason that all of this is also so incredibly fascinating is because we also had such an incredible part of the actual monetary base. I already had it up there. That was created in 2020, right? So you had a massive rise in the entire monetary base. You went from $16 trillion in money that's in circulation up to $22 trillion. 6 out of 16 is almost half of the entire monetary base of M2, to be fair. came into circulation within a couple of years of a period. And now we had some of that money come back out of the system as the Fed started to tighten and basically pull money out of the system. Um, but now that's coming back up again. And so this is actually the better metric to look at when we're trying to gauge what kind of inflation might come in the future. Now, this isn't really like full on the answer to that, right? Because it also depends on how much productivity there was. So let's talk back about that, because he talked about that a little bit towards the end. And I thought that that was something definitely worth commenting on. He talked about how, well, they were asking about AI, and he's really doing an amazing job of saying that AI is not taking all the jobs. It's not preventing people from getting jobs and things like that. But what it's almost laughable, because today, what did we see? We saw Amazon making major layoffs, and I think we also saw Pinterest making some layoffs as well. So Amazon accesses 16,000 jobs, okay, as it pushes AI and efficiency, right? So clearly AI is not taking jobs, okay? That's not happening. Don't look over here, look over there. But the companies themselves are actually saying that this is the case. So let's see if Pinterest also had layoffs. I'm not sure. I think I heard that somewhere. Pinterest cuts workforce by 15% to focus on AI. So, okay. That is exactly laughable. I didn't know that they were even going to say out loud that that was what the cuts were about. So, anyways, so the question was if you're having the economy growing, right? So, because the Atlanta Fed has GDP, Atlanta Fed now has put out a GDP read of around 5% that they're expecting in Q4 of 2025, right? So the Fed now is they take more, they're taking data in and trying to get a more real-time read, because GDP doesn't come out until into the next quarter. Okay, so they're saying, well, before Q1 is over, let's put out a GDP read, and it's looking like it's going to be around 5.3% for Q4. And so this lady was saying, okay, the labor market is giving us some signs that things are weakening. It seems like people aren't hiring, people aren't able to get jobs, yet GDP is ticking up and completely going higher. And so the actual, like, almost mathematical answer to that is that productivity is increasing. That's basically what that means. If you have a higher GDP with less labor, then that means that you have higher productivity. And so what's happening here is exactly that. Now the question was is that because of AI? And what he keeps saying is that, well, not necessarily. And yet we get these headlines that tell us very directly that they are cutting people off, they are laying people off in order to focus on AI. So this is actually a pretty important piece of this equation here. We talked about in previous streams this idea that if the Fed continues to cut rates and that leads to increased investment, will this investment go into labor? Will that actually get people more jobs, or will that lead into higher investment into things like AI, which will actually accelerate a weakening labor market, right? So this is a real thing that the Fed has to look out for as they continue to move forward. And this might be a part of the reason why the Fed does not want to cut rates. Now, one of the things that I meant to bring up a second ago that I have not yet is this trueflation thing. So trueflation, look, it's just an independent provider. The Fed has their ways of collecting data. A lot of people question the way that the Fed collects data. And now we also have to question whether or not we can trust government's data. And it's not just the Fed that's collecting labor market data or inflation data per se. It's you got the BLS and the BEA, I believe, is the other one. And so, but the point being here is the data that's being used to describe whether or not we're dealing with inflation is not necessarily all the way super hyper accurate, and maybe has not ever been. So these third-party providers like this Trueflation, guys, I'm not getting paid for this. So if you hear or you know Trueflation, tell them they can reach out to me and figure that out. But essentially, we're looking at the fact that in real-time data, because they're going out and collecting data from all of these different people. They're getting it from Amazon, they're getting it from all these different places, and they're saying this is the actual inflation right now. It's about 1.16%. And so people are like, wait a minute. If inflation's at 1.16%, but the Fed is keeping interest rates at 375 basis points, then essentially we could end up in a scenario where prices actually start coming down. And now, as a consumer, we're not going to be mad at that, right? Prices coming down doesn't sound terrible. But for businesses, right, that can cause a crunch on their profits. And when you have that, you can kind of get into this whole scenario where business stops spending money. They definitely stop hiring people. And then, economic conditions can turn down from there. This is the problem that Japan has been facing for quite some time. So people are concerned about the Fed continuing to hold rates. He says we're at a neutral rate, right? This is the rate where everything will be just fine. The labor market will get stronger and inflation will stay in check if we stay at this rate. And dealers are like, well, you might want to lower rates because inflation is coming down and we need to get some pressure on the economy, saying that to get the prices to come back up, or at least to be at around 2% inflation, which is the goal of the Fed. So those are some of the main things that I heard from this. If you're a member, obviously you can put some more comments in the chat. I think next time we might try to do a non-members only chat. I think that this has been pretty good. You guys have been asking some questions and putting some stuff in here, but I definitely want to make sure that we keep discussion as open as possible. So speaking on that, guys, tomorrow at 12 p.m. Eastern, I'm going live again like I do every Tuesday and Thursday on Memes and Markets. Guys, subscribe. I'm serious. So what I'm going to do is I'm going to show you guys exactly how you subscribe. You go to the description box of this live stream. There's 2,600 people here. And if you guys are enjoying this, you will absolutely love Memes and Markets. So come to the description of the video. I'm talking to you right now. I'm talking to you. Go to the description of this video that you're on right now and click on Memes and Markets. Oh no. Is that what's been going on? Okay. And hit that subscribe button and turn on all notifications. Guys, we're going live tomorrow with Clive Thompson. All right. Clive Thompson is the man. I know y'all watching because I see it in my data. I can see who you guys watching. Clive Thompson is up there, and he's going to be live with us tomorrow on Memes and Markets. Okay, we're at 10,200. Guys, we just hit 10K subs on Memes and Markets, which is awesome. But it's not where we need to be, guys. 2,400 people in here. Come on now. Hit that subscribe button on Memes and Markets. Hit the like button on this stream as well. And understand that we're going live again tomorrow. Now, let's look at how the market is reacting to all of this. Because I actually haven't looked at all. What are we doing? Okay, well, it doesn't want to let me know how the market's reacting to this right now. Let me go ahead and pull it up right here. What is going on? All of a sudden, this doesn't exist. Well, the NASDAQ is down. Something really bad happened on the CME. No, I'm just kidding. The market is doing just fine. Not much of a reaction from the S&P 500. Okay. Gold, guys, soaring out right now. My goodness. Crazy moves from gold. Oil. That was something that they talked about as well. So oil has not necessarily been rising super hard. These past couple of days, it kind of has. This week, it's pushing up a little bit. Nothing major compared to the actual craziness that we've seen. And so he kind of pointed to that. He was like, even though we've seen all of this madness, the price of oil is not really continuing to rise. And I think that's a really important thing to think about. There's two ways in my eyes that you can look at that. Oil pretty much always is going to rise whenever you have geopolitical tensions or the potential for war. Why? Because you need oil in a war, and you get a lot of supply constraints in a war because now people aren't necessarily freely selling oil to one another. There might be reasons why I'm not allowed to sell oil to this person or that person, right? So then the supply gets contracted and the demand is going up at the same time. And so when you get war fears, you get high spikes in the price of oil. But we haven't seen that, even though we had a few different things that the U.S. government has done, going into Venezuela, potentially causing some issues there. Same thing with Iran, almost potentially getting involved there, still not necessarily fully doing it. And so that's another thing that should lead to higher oil prices, but it has not been. So anyways, those are some of the main things. I'm going to look at my notes a little bit here and see what else I might see. I'll probably be making an entire video about some of this as well, so we'll get another recap. How is growth happening? The labor market's weakening. Yep. So the only other thing I think that I haven't really touched on is just how he's saying that they're getting a better read on what tariffs actually mean as the data continues to come in, which is fair. And it's actually quite incredible that they might have been able to actually keep track with this stuff as it has come out. He said that the forecasts were not too far off. Independence of the Fed. We can talk about that super quick. Oh, I guess you guys haven't been seeing me. I don't know what happened there. Oh no, what happened here? Give me just a second. It's a battery problem. And I won't hold you guys for too much longer. But the Fed remaining independent, right? This is the thing that he didn't want to talk about, but Donald Trump has essentially helped. The Department of Justice has been coming after the Fed, supposedly about what they say, the Fed building being, or the costs being lied about or whatever. And then Jerome Powell put out that press statement on Twitter, which is so wild, by the way, that's the way that we live in the world today. That's how news gets out and how we talk to the press. Saying, hey, this is actually just about the fact that we're not lowering rates for him. And the problem here is this. Elected officials, they are the people who want everyone to vote for them, right? As an elected official, I need you to vote for me. And so what am I going to do? I'm going to tell you all these amazing things, and I'm going to make sure that the economy is doing well. I want the economy to be doing super well. But the problem with the economy just doing well, or me just providing a bunch of stimulus to the economy by doing a bunch of government spending and trying to have control over the federal funds rate even, is that now there's nobody to keep in check how much this growth of the economy will then lead to inflation. Because the growth of the economy is great for people who need jobs when the growth of the economy actually leads to more jobs, which right now is potentially not. But it can also lead to higher prices. And for people who don't own businesses, who don't own assets, who don't own real estate, that can be crushing to have the prices of everything going up. Now, so the Federal Reserve, their job is not to play the politics of the economy doing well per se. They have two specific mandates: high employment, maximum employment, and sticky, stable prices, which is 2% inflation is a stable price, whatever. And so just like Paul Volcker, he talked about Paul Volcker because he went into a Supreme Court decision this year, and he said, he quoted back to Paul Volcker. He was like, Paul Volcker did this once, so it's not unprecedented for me to go and attend a Supreme Court meeting. But besides the point, Paul Volcker is also an American figure at the very minimum. Because what did he do? He raised interest rates to like 20% or something crazy because inflation was going insane and he needed to raise interest rates in order to get inflation back in check. And he had to do this, I believe, twice over his career, which meant that he had to create 2 recessions. But the only way you're going to get somebody to create a recession in order to keep people who are not doing as well as other people from getting hurt, you have to not need to win an election. Right? Because the general population is not going to be cool with you causing a recession per se when inflation is getting out of hand like that. Now, technically, they might actually like you for that, but it'd be really hard to get people to like you for causing a recession and potentially making things even worse, just to make sure that inflation doesn't run away. So anyways, the independence of the Fed, he commented on that. He said that advanced economies around the world, they need that, right? They all thrive on that fact that you have independence between the Fed and the executive branch of the government. And so, anyways, that is kind of, just wanted to break that down real quick as well. So I'm going to wrap this up here. There's not too many questions in the chat. Next time, guys, we will open up the chat. We had 2,800 up to 3,000 people in here today. I'm super, super excited about that. That is awesome. But it doesn't mean anywhere near as much as it would if it was on my show that I do every Tuesday and Thursday at 12 p.m. Eastern, Memes and Markets. So hit the description box. Go to the description box of this before you leave. Click on subscribe to Memes and Markets. Yes, I am pushing this left and right because, guys, this is by far, Memes and Markets is by far it's the most exciting project I've ever done. It's the most fun I've ever had. And I will continue to scream to the rooftops. I've got 192,000 subs here. I want you guys to go and subscribe to Memes and Markets because that for me means a whole lot. So anyways, thank you guys all for being here. I'm super grateful for all of you for being here at all. And I will certainly probably do my best to do the next live stream for the FOMC as well. You guys know I like to kind of go around to different places, and sometimes this would potentially be at like 3 a.m. So that wouldn't work at all. But so much appreciation for you all. Next time we'll open up the chat to see how that feels. But if it gets out of hand and you guys are acting crazy, then I will put it back to members only. But this is crazy. There's still 1,900 people in here. Thank you guys for joining. And I will see y'all very, very soon. And until next time, peace.